Florida, Jacksonville, beauty. I've been there. Well, I'm in New York. I've been to Florida many times. All right, let's get started. So, one issue we did have was the McGraw Hill. It's just the usual stuff. I mean, this is nothing new. Um, to be perfectly honest, you have these issues all the time. Uh, you should see my screen now of the McGraw Hill. You should see my McGraw Hill screen of our classroom. And if one more, I know I'm bugging you this morning, Angelia. Do you see my screen? Good, good, excellent. Wow, you're really good at this. Yeah. So we had a little bit of an issue. We had a little bit of an issue, but it's fixed now, and that's good news, right? So this is really an accounting class. Not It shouldn't be very difficult for you. It really shouldn't be. Uh, I just want to share something if I didn't already. I should have my interactive spreadsheet, so bear with me for a minute. Bear with me. Okay. Uh, okay, hold on a minute. Very important, I feel, that for those of you at home that are watching this, and hopefully you are watching this because it's part of the deal here, that you take a look at this spreadsheet and take a look at these videos. These videos are designed to give you a firm foundation in accounting. So they're going to go through all of the parts of the accounting sheet. You're going to get to know the balance sheet, the income statement, and the statement of cash flows. You're going to get all three, and this should be a big help to you. Okay. And furthermore, I'd like to give you access to my interactive spreadsheet. Okay. So I just want to give you that. And I have a lot of stuff here. And um I make a lot of videos to help you. And just when you go to this accounting channel, there are other things. You could use other things. You don't have to just use the interactive spreadsheet. You could use any, there are other accounting videos. So make sure you make it available to you. So that's going to be part of what I want to show you. And I also want to, just for people who like to have things in the content portion, right? You people some people want to have things in the accounting, in the content portion. Well, then I'm going to go to the content portion, and we're going to go right here, and you're going to get a lot of stuff from McGraw Hill. So, but this is my information, okay? This is going to be my information. So I'm going to create a folder, and we're going to also put, hopefully, bear with me. So this way you know where to watch these things, okay? Hold on a minute. Always something. Panic button. Sorry. There you go. And we're going to put that right in there. Okay, there's my accounting playlist. I don't like the way that looks. I just want you to know where everything is. I don't want to waste a lot of time here. But on the other hand, I don't want to screw you guys up. So why don't we cancel this? Why don't we delete this? There may be a better way to do this. I mean, we could just leave it alone. And I don't want to waste a lot of time here. But let's just try one other thing. Well, I think you got it. Let's leave it in the messages. All right. So when you use McGraw-Hill Connect, once you get into McGraw-Hill Connect platform, you just go through the activities, right? So for instance, with the first video, you go through a video lecture, right? So the first video lecture is going to lead you through the work. But once you launch it, good. Once you launch it, and now the problem here is I'm showing it to you from the um, professor's standpoint. And not you're seeing it from my standpoint. So it's going to open up a little differently.
All right, in this video, we're going to talk about the role of accounting in society.
And there you
And
go.
I know for a lot of you, this
And
is
then
your
he's going to
first
give,
accounting course. And for many of you, you probably have no idea what accountants actually do. And so in this video, we're going to attempt to answer that question. And to understand what
and there you go back to Blackboard and you watch that video. And you can watch my videos, you know. This isn't just about watching that video, right? You can watch my videos. You know, I got to tell you, let's try this. There you go. Let's go. I want you to have access to this. You have their videos and you have my videos. And of course, I'm going to be a little partial to my own videos because my feeling is I know I created them, you know, I created them for a reason. So you're going to put that in. Now let's see if that works. Here we go. Beautiful. And we're going to make that visible to students. So when you open it, there you go. There you go. And then we're going to bring in a document. We're going to also bring in a document. And this is going to be an interactive spreadsheet. And we're going to make that visible to students. Now you have everything, okay? Now you have everything. It's right here. All right, so let's talk a little bit about the overview of what you want to learn. So once you, okay, let's finish this. So once you watch the video, then just you simply go in and do the assignment. And the first week is really an introduction to accounting. I mean, we'll be leading you through other things. But I will tell you, if you watch my videos and just to get a start, because they're going to have their own videos, McGraw-Hill, and that's how we designed the class. That's how the school designed the class. They did a great job with it. Well, then at that point, you're going to want to like maybe want to go the next step. So this is how this woman, you know, organizes a charity fund to cover the medical expenses, and you're going to just show how different actions that are done increase or decrease the balance sheet, right? Okay. And you get an idea. So it's a recovery fund, increases cash, it decreases the payment, it does different things to the balance sheet. And then you do that exercise. There's 6 exercises. They're not terrible. I mean, you have to put some time in, and really it's very mechanical accounting. Accounting is very mechanical, but you're going to feel good as you start to learn it. Once you really put the time in, it's going to start making sense to you. Okay. Once you put the time in, it's going to start making sense to you. So there you go. Like what's a liability? It's an obligation to pay cash in the future, right? Right. What are retained earnings? Well, if I have assets minus liabilities, that's going to equal retained earnings. Right. And then you just keep going through and doing these problems. And once you're complete, you submit it and you'll get credit for it. And you'll have hints. You can report a content issue if there's anything. We don't see that happening. It'll make a lot more sense to you. Okay. So you're going to do those and you're going to be done. And obviously, this is the live classroom. So let's talk about exactly what you're going to be learning. And then you can also do a quiz. So when you open up the quiz, so you got a little bit of work here. And some people have already begun the quiz. You're going to do the quiz. And it's going to be based on accounting. Okay? Now, let's talk about different forms of business. So accounting is important because let me see if I can make that bigger. Accounting is important because it provides an organized and accurate method of recording and reporting events. Events involve at least 2 different entities or business. These forms are. You could either do a sole proprietorship. There's 3 ways you could start. You can basically form your business. Because when you start a business, you have to have formation. You have to have an entity that the business exists in. Now, most of the money in America, most of the capital is in corporations. But most of the businesses are smaller businesses and they're sole proprietorships, which should make sense to you. So what's a sole proprietorship? It would be something like a your local salon, your local pizzeria, your local Chinese takeout, things like that form the basis of a sole proprietorship. So the thing about a sole proprietorship you want to know is they're easy to start, and you have full control over the business decisions, but you also have limited access to funding, and you're solely responsible for the risks, right? So the money you make or lose goes directly into your accounts. Money you make or lose goes directly into your accounts. Hold on a minute. I'm sorry. You know what? I always get a little paranoid. I'm just stop sharing for a minute. Whenever I do, I'm never like for some reason I'm really not confident always with Microsoft Teams. So I just want to make sure. Okay, good. We're still recording. That's all I wanted to make sure. So, and we are still doing everything. Good. So you have they're easy to start. The income flows directly into your W-2. And it's basically you're an owner, and that's how the business decisions get made. Now, in a partnership, it could be a law firm, it could be a medical firm, where the partners get together. It can also even be a hedge fund where there's a managing partner who manages the investments. And then there are limited partners who have limited liabilities, and they give you the money to invest for them. That's really how a hedge fund works, right? You have a partner or a couple of managing partners who have the sole responsibility of taking the capital and following the rules and investing the money. And then on the other hand, you might have a medical partnership or a legal partnership, and the partners formed a partnership to give themselves limit. And most partnerships, the one you want to really always use, and if you ever decide to do anything, you always want to consider, is an LLC, a limited liability corporation, where your liabilities are limited, where you cannot be responsible for liabilities. And then finally, you have the corporation, which is this big entity that has to follow rules. You have to file with the SEC. If you sell stock, you have to meet all kinds of, rightly so, accounting rules. But what a corporation really was invented to do is for people to sell their resources. Think about it like economically. They sell their resources to the corporation. So if you're a very good marketer, but you don't want to run your own business because of all the complexities and you don't even know where you're going to find the capital or the clients, the corporation makes the economy so efficient because now this marketing person can go join a firm that sells something, let's say automotive, General Motors, and join the marketing team and get paid. Now you may not get paid as much as you would as an owner because you're selling your resources, but being indemnified by the corporation, which kind of protects you, right? Because the corporation has accountants, they have lawyers, they have all kinds of supervision, they have other marketers that'll work with you. But the good news is you can make a living without those headaches and you will get W-2 income. You're not going to build much equity. You can build equity from just if you're a very good marketer or you're very good. But you can start your own business and turn it into a corporation. And those are where these tech people come from, or people who start businesses. But the corporation has essentially been the bedrock of American capitalism because but the other methods have given you chances to start businesses, and most get formulated that way. But the corporation allows you to sell stock and really grow with a lot of and one of the downsides is a lot of regulation. And if you do run afoul of any regulation, you get in a lot of trouble, and that rightly so. I mean, you shouldn't have to be doing anything to get with the idea that you want to get away with something. And then double taxation, which means that you pay taxes when you earn money in the corporation, you pay taxes. The people get the dividends. That's how corporations work. They give you a dividend. You're a shareholder, you give them money, you have a share of the company. If they make money, they either take the money and plow it back into the company to reinvest and build, or they give you the dividend, which is a payback. But you get taxed again, even though they're better tax rates, you still don't want to deal with that, okay? So once again, the sole proprietorship has limited access to funding because you really just as like an individual running a business. You're solely responsible for any risks. In a partnership, you share the risks, but there's complex decision making as to how you break up the profits, how you break up the liabilities, and things like that. But you can put it in a limited liability and limit your liability, which is good news. You can never limit your liability from criminal activity. Remember that. You're a criminal, you can get in trouble because it doesn't matter what the thing is. But you can limit your liability from some sort of uh, risk or something you took, that didn't like you just made bad business decisions. Well, that's not criminal. That just means you're a bad business person. But that limits your liability. And corporations are the biggest form, that we use. So those are all going to be how in the beginning you're going to have to know about those, and that's a good way to start doing this kind of work. How business events affect the accounting equation. The accounting provides information to stakeholders. Accountants record transactions and report to both internal and external stakeholders. One basic tool to show business events is the accounting equation. So the accounting equation basically is this. It's an identity. On one side, you have assets. That's everything you own. And that's got to be same. And one thing about accounting you're going to learn, if you don't have any familiarity with accounting, is the one side always has to balance out the other side. That's the whole idea, the checks and balances. So if I have assets, things that I own, that's worth say $500,000, and you have cars that are worth 100. A couple of cars, say 600, and then let's say you have other assets that are like cash or stocks. It's worth 200. So you got 5 plus 1 is 6 plus 200 is 8. You got 800,000 in assets. But now, what do you owe on that? So maybe the house has a $300,000 mortgage. Maybe you're worth 4. So it has to balance out. And if you know two of these numbers, you know the other. So if you knew the liabilities and the equity, you would add them up, and that's the assets. And try to remember that, because as you're trying to solve certain problems, the way we teach accounting, the way most places teach accounting, is they'll give you questions and they'll really kind of force you to think about the equation to answer the questions. Like they may not directly tell you what these are, but they'll tell you the assets and the equity, and you back into the liabilities. Or they may not tell you exactly what equity is, but they'll give you assets minus liability, and you'll tell them equity. But if you don't know how that equation works, you're going to miss those things. So make sure that you do it that way. And accountants rely on double entry bookkeeping, right? So now you can use software. A lot of this stuff is already mechanized or digitalized. It's put into the computers. Obviously, may change the world, but everything you always have to remember. There's always checks and balances. So when you look at things like what are assets, it could be cash you have, it could be accounts receivable, which is money you lend to your customers and they're supposed to buy to buy your product. Now they haven't given you the cash yet, they borrowed, but the accounts receivable is actually an asset because eventually it's going to turn into cash as long as you collect it. And if you don't collect it, you got to write it off, is what happens. But most businesses have steady customers who borrow money or have terms like 30 or 60 days. So once they make the sale, if they've been a steady customer, you know that the asset is not cash yet, but will turn into cash. Then you have supplies, the things you use to run your business. Anything like that you prepaid, insurance, utilities, any kind of fixed expense that you've prepaid is going to be an asset because you haven't used it yet, but you're using it to make more money. So it's an asset. Then you have equipment, which, if you're in a corporation, there are things that you use to, build other things and sell. We call that capital. Capital goods are things that we use to make other things, like when you buy a PC or a truck. That's capital equipment. It's an asset. But why did you buy these things? You bought them so you could produce things. And then finally, building, same thing. The building is there to help you make money, but it has a value. Then you take away the loans or the money you owe against these things. So accounts payable. Now this is money that you borrow, you took supplies in or materials from other people who sell them and you owe the money. So eventually that's going to be money you're going to owe, and that's why it's a liability. If people have earned money like through bonuses, or maybe they get paid monthly and you close your books in the middle of the month, well, you have a wage payable. You know that even though you didn't pay it yet out of cash, you're going to owe that money, and you have to the users of your accounting statements have to see everything the way it should be on the day you close your books. So even if you haven't paid it yet, you have to account for the money that they've already earned. So always remember that in accounting, you have to match revenues with expenses. And the only way you can do that is on the day you close books, you always make sure everything matches out to the day it happened. Even if you didn't pay it yet, you account for it. Rent payable, right? You owe money, right? Maybe you haven't paid rent. Maybe you pay rent every 6 months and you close your books on the third month. You have to account for those 3 months. Not all six yet, because you didn't use the other three, but the three. And that's the only way your statements are going to be accurate, because then you could show the exact expense versus what you earned. Then any unearned revenue, something that you haven't earned yet, is going to be a liability, right? If you haven't earned it yet, it's going to be a liability. It might show up in cash or it might show up in accounts receivable, but you haven't earned it yet. And that's got to be taken out. Then notes payable, which is notes are always going to be the short-term loans you make. Think of them like credit cards, so short-term. Anything that's short even from the government standpoint, when they issue short-term bonds or debt, it's notes. But long-term are going to be bonds. So that's like a mortgage is going to be a long-term debt, but they're both liabilities. You just have to list them in the order of liquidity. Always remember that. Your balance sheet is always listed in order of liquidity. So the most current stuff goes up here. The older, the older stuff is going to go down here. And then once you subtract it, it's going to give you your equity. And that's going to basically be your stock, any dividends you wind up paying out, any money that comes back to your firm. That's going to turn out to be equity. Okay. So what you own minus what you owe is what your equity is. Okay. All right. Any questions? So ownership interest is shown in the capital account. You have authorized stock. Now that's going to be the number of shares. But just give me 1 minute. I want to just get a glass of water. If you could just give me 1 minute. You're going to have things like the stock you authorize. That's just the amount of shares you could sell to the public. They're not issued yet. They're just what you authorized. Okay. So if you have a company of 1 million shares outstanding, you might have only issued 200,000. The rest could stay in an account for later issuance. So it's just really when the company was formed, you authorize shares. Then you have treasury stock, which is issued stock the corporation buys back from the public. So sometimes you sell the stock to the public, they give you the capital, but at one point, and it happens a lot, you start buying back that stock. When you buy back that stock, it goes into your treasury account. And finally, when you take issued minus treasury, you're going to get how much you have outstanding. So that's like an overview of the accounting equation, right? And then let's look at these assumptions. So accounting assumptions are basic presumptions used when preparing financial statements. Accounting principles are standards or rules that apply to how events are reported on financial statements. In the United States, the framework for preparing financial statements is GAAP, generally accepted accounting principles. Those are basically the rules of accounting. So anything you do, and every company has different rules. Like airlines account for things differently than, say, retail, and retail accounts differently than oil drillers. But GAAP covers everything, right? And you have to follow that. And the FASB, the Accounting Standards Board, maintains a database of the official standards for financial reporting of U.S. companies. Of nonprofits, international financial reporting are used outside the United States. In addition to financial reports, companies must keep records that comply with the IRS because you have to pay taxes. So here are the assumptions we make as accountants: that we're a going concern, that the assumption is that the organization will continue to run and not be closed, that we're an economic entity. The assumption is that business activities are kept separate from the owner's personal activities. Very important. You run afoul of any of these rules, you're going to be in trouble. right? Well, I mean, of course, you got to make representations that you're going to keep running. But something like this, if you mix your personal accounts with the business accounts, that's where people get into a lot of trouble. So you definitely don't want to be doing that. Monetary units that you're coming up with some sort of monetary. So if you're doing business in Germany, it might be the euro. If you're doing business in the UK, it might be the pound. Here, you assume it's a dollar. What time period are you using? Are you using an annual time period? Does your books close on December 31st? Do they close on July 3rd? You have to pick a day. Usually it's the end of the year. Cost principle. Accounting information is back based on actual costs, not costs that you want to use to make your accounting look better, but the actual cost that you paid. Okay, so even if you bought, well, let's say you were a jeweler, and a month ago you bought gold to make jewelry to sell, and about a month ago, gold was almost at $3,000. And because of the election and stuff like that, and I don't bring politics into the classroom, but because of the election, it's now trading at 2,600. So anybody who bought gold a month ago basically takes a $400 loss. Well, you can't use the 400. You can't use 2,600, which would make your profits look better, right? It's lower cost. No, you got to use your cost. So that's what that means. Revenue recognition. Revenues are recognized when they earn, not when you get paid, when you earn them. So you may get paid ahead of time for things you didn't do yet. You can't count that. You only account the part that you earned. And the revenues have to be matched, which is what I was getting at before. You have to make sure your expenses match up with your revenues. So again, if you prepaid your utilities for a year, but you close your books in the first 3 months, you match the 3 months, not the year. You don't make lower profits. You don't show lower profits because they're not lower profits. Only 3 months of the expense went into this. Maybe some people want to show lower profits for tax reasons or whatever. You can't do it. You got to match the principle. Matching principle has a lot to do with what you're going to learn here, because you got to do accruals. You got to make sure that whatever you use is accounted for, not what everything you paid for. Or again, if you went ahead and paid your lease for the year, and you close your books in 3 months, the first 3 months, well, you only use 3 months of rent expense or lease expense. You don't use a year. You have to be very clear on that. Organizations should report the details behind the numbers presented in the financial statements. Footnotes are really important. So I know a lot of you are in the human resource program, so I don't know how far you're going to go into this, but you definitely, when you're looking at any kind of income statement or financial records, and you can go to any company and they have a shareholder investor relations, and they have all the books and records and things they filed with the SEC. There's also other sites like Edgar that has the SEC sites and stuff like that, which is all great. But the best thing you could do, I mean, you got to read a lot of this stuff to really get good at it, because there's a lot of boilerplates. Like when you take out a mortgage or a car loan, there's all this stuff that keeps showing up all the time. It's just what we call boilerplate. But as you read, you start to realize, oh yeah, that's in everything. What's the stuff I really need to know? The footnotes are really important. Footnotes explain what's going on with every company. So as a reminder, as a kind of hint, or a little bit of a hint from the professor, use your footnotes. Then there's materiality. You have to worry about the stuff that's really material. If something is if you're running if you're running a $10 million company, and you have a problem with a $200 expense, no account, and even the government's not going to come after you for $200. Doesn't mean you want to play around with your numbers, but it does mean it's not material. So you don't have to you really got to worry about the stuff that really has an effect. And then finally, the conservatism. When two estimates are equally likely, the less optimistic. So there are going to be times where you're going to have two choices to count for something, and one might look better than the other, but you pick the one that's most conservative. And that's basically what we need to, you can go through the tutorials. I would definitely do that, because they're going to show you how to use it. So I would definitely go through the Connect orientation videos. I would call those up, and I would start my work with that, because that's going to give you a great start in terms of learning how to use Connect. Always a good thing to do, because you really want to learn the system. So the key word for this week is going to be accounting. The key word is accounting. ACCONTING. Okay, of course, I'm not going to play it for you. You'll do it yourself, but that's what you need to know. Now, if you go back to my stuff, how would it help you? Now, after you watch the videos, I would suggest if you really want to dig in, you would download the spreadsheet. Download the spreadsheet. And when you open that spreadsheet, I want to make sure I'm sharing it. Angelia, could you let me know if you see the spreadsheet? Did you see the spreadsheet? Are you there? It's in the chat, maybe. Yeah, great. Thank you. So the spreadsheet, that's great. It's got the income statement and balance sheet on the first tab, retained earnings on the second tab, statement of cash flow. So you're going to be learning this stuff as we move along, but it allows you to click and see how it goes together. So notice when you have all of these expense, let's go up here. Sales minus cost of goods sold is your gross profit. But if you click on that, you could see that I did it as an equation. Here's all your expenses in this particular company. Notice I added them. Here's my profit, right? Notice I took this minus this to get my profit. So you, as you're watching my videos, you can also click through these to learn about how it visualize how the accounting spreadsheet works. And that's basically it, my friends. That's basically it this week. If you need anything, you know where to reach me, right? Just message me. I know that we got started a little late in terms of, not too bad. The administration really helped me in teaching me how to get this thing back in line. But, make sure that you, get started on McGraw-Hill. You got until next week. And contact me if you need anything else. And pleasure to meet you, Angelia. And this meeting we'll try to set up every Saturday. If I am going to make changes for whatever reason, I'll let you know. Have a great day.